Hey guys, hi, welcome to the channel. This is Vineet. Today we are going to talk about Warren Buffett. He's arguably the greatest investor in the world, and he has been investing for a long time. He started when he was just 11 years old, and today he's around 90 years. So that is 79 years of investing experience that we can learn from. And throughout his time, he himself has made a lot of mistakes, as well as he has seen a lot of mistakes that other average investors have made. Today, I'm gonna let him explain the 8 very important mistakes that we all can learn from. I'm sure if you're an investor, you will correlate with these points. So let's get started. Mistake 1. Not pulling the trigger on a stock.
I was just wondering, what would you consider to be the worst investment you've ever made?
The worst investment I ever made? The biggest mistakes are the ones that actually don't show up. They're the mistakes of omission rather than commission. We've never lost that much money on any one investment, but it's the things that I knew enough to do that I didn't do. We have missed profits of as much as, maybe $10 billion in things that I knew enough to do and I didn't do it.
Mistake 1. So this is one of my favorites. Warren says that the biggest mistakes he made are mistakes of omission rather than commission. So that means the mistakes of not taking the right action. He says he never lost that much money on any one investment, but it's the things that he knew enough to do, but he did not do those things. And due to these things, he has missed around tens of billions of profit which he could have earned. In our lives, even we make such mistakes where we know a particular good stock but we don't buy it, or we don't increase our SIP investments and so on, or we withdraw funds. Mistake 2. Dancing in and out of stocks.
And the question we get most frequently from people about you coming on is, what should they be buying right now? So if I say buy, you say?
I say basically hold. I mean, the idea that the European news or a slowdown in this or that or anything like that, that would not cause you if you owned a good farm and had it run by a good tenant. You wouldn't sell it because somebody said, here's a news item, this is happening in Greece or something of the sort. If you owned an apartment house and you got to raise your rents a little, it was well located, and you had a good manager, you wouldn't dream of selling it. If you had a good business personally, the local McDonald's franchise, you wouldn't be thinking about buying or selling it every day. Now, when you own stocks, you own pieces of businesses, and they're wonderful businesses. You can pick the best businesses in the world. And to buy or sell on current news is just crazy. You're in a wonderful business. You got people running it for you. You know you're going to do well over 5 or 10 years. And to think news events should cause you to try and dance in and out of something that's a wonderful game is a terrible mistake. So get into a bunch of wonderful businesses and stay with them.
Mistake 3. Buying cheap stocks of poor quality. This is again very important mistake.
Well, I've made a lot of mistakes. The biggest mistake, well, not the biggest, necessarily the biggest, but buying Berkshire Hathaway itself was a mistake because Berkshire was a lousy textile business. And I bought it very cheap. I'd been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
Mistake 4. Buying airline stocks. Now, this may not be applicable to every investor, as not everyone invests in airline stocks, but definitely something to keep in mind. If you are finding the video useful, consider subscribing and press the like button and give it a thumbs up. Your support will go a long way in growing this channel.
I went into U.S. Air. I bought a preferred stock in 1989. As soon as my check cleared, the company went into the red and never got out. I mean, it was really dumb. I mean, I've got an 800 number I call now whenever I think about buying an airline stock. I call them up any hour that, fortunately, I can call them at 3 in the morning, and I just dial and I say, my name's Warren, I'm an aeroholic, you know, and I'm thinking about buying this thing, and then they talk me down. I mean, it takes hours sometimes, but it's worth it, believe me. If you ever think about that buying an airline stock, call me and I'll give you the 800 number, because you don't want to do it.
Mistake 5. Buying great stocks in small scale or small quantities.
We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. You know, it's easier now than ever because you can do it online. You know, just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life. You would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Mistake 6. Buying stocks high and selling them low.
Investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, you know, or the neighbor says, you know, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 48, from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime and securities markets.
Mistake 7. Waiting for a market crash. Now some of you may have heard the quote from Peter Lynch which says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves.
Unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, you know, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you know you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, you know, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, you know, that you sort of take the attitude of a mortician, you know, waiting for a flu epidemic or something. I mean, I'm not sure that I'm not sure will be a great technique. You know, I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. And it won't be quoted tomorrow or next week or next month. You know, I think people's investment would be more intelligent if you know, stocks were quoted about once a year, but it isn't going to happen that way. So.
Mistake 8. Following the madness of crowds.
The country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but you want, you know, it doesn't take brains. It takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%. You know, I started selling securities when I was 21, and a Kansas City life insurance company happened to be a fairly prominent company in Omaha, and the policies they sold you, if you were buying life insurance from them, had a built-in assumption of 2% interest. The stock of Kansas City Life was selling at less than 3 times earnings. You were getting 35% if you bought the stock. No question about the soundness of the company. I went to the local agent. I figured, hell, I ought to be able to sell him a few shares of stock. I mean, the guy ought to understand it. He's got his whole life invested in this company. I went to the local agent who'd been with him for 20 years, and his name was Moose. And I said, Mr. Moose, I said, you know, you're selling these policies with 2%. You may even have a few members of your own family, and you can buy into this company whose paycheck you depend on every month, and whose future your beneficiaries of these life policies depend on, and who you're selling them, you know, a 2% investment on, and you can get 35% on your money. And he said, you know, stocks aren't any good. And I couldn't sell you, you know, I was a lousy salesman. I mean, well, you have to start with that, but it just blew me away. It blew me away. I thought, sometimes I used to wonder if I was nuts, you know.
Now those were the 8 mistakes we could learn from, and some really great points. And the thing is, if you can spare yourself from making these common investment mistakes, you can save a lot of money. Any big mistake can cost you around 20, 50, or even 100% of your investments. This can take years or tens of years to make it back up. So it's important that we don't just follow the madness of crowds, that we don't just wait for a market crash, and that we don't give in the fear and greed. And again, we should not dance in and out of stocks, because making these mistakes can cost us a lot of money. And it's always helpful when we can learn from somebody like Warren Buffett, who is the greatest investor of all time. Hope you liked the video, and if you found it useful for your investment journey, give it a thumbs up and consider subscribing.